for most of the year in 2020, the state took over everything. I mean, we all became wards of the state, right? Businesses, households, everyone. I mean, nothing remotely close to that has happened in American history. Now, that example won't go away quickly. You know what I mean? People will remember that. Yeah, that you can do that, right? Everyone was dependent on the state, even major corporations, to renew turn over their loans. I mean, everything, right? The combination of huge fiscal largesse plus the Fed policy, right?
The stimulus has been, unprecedented.
Yeah, and it by the way, it rewrites the rules of the regime. And, I pointed that out. I mean, if you look at the 6 quarters of the pandemic and compare them to the quarter before the pandemic, the last quarter of 2019, we've had something like a 7% growth in real disposable personal income. At the same time, we've had a 2% decline, or nearly 3% decline actually, in real GDP. That is unprecedented, right? A 10 percentage point gap between what we're earning to be able to spend and what our economy is producing. I've gone back and looked at all the earlier recessions. That gap is never more than like 1.5%. So where did all that free money come from? It came from borrowing. It came from borrowing. And it came from, first of all, borrowing by the federal government, which we've seen it ramped up. We went into the recession, by the way, already under Trump at a federal deficit of nearly 5% of GDP. That was already a record for a non-recession year. Before the pandemic, we were 4.8% of GDP. And, everyone was fine with that. Jerome Powell was fine with that. Donald Trump was obviously fine with that. And then the next 2 years are at 12.5% of GDP, right? So that was an extra 5.5% of GDP kicker in 2 years. Well, that translates into about 10% of DPI, right? Disposable personal income. So that's how you get there, right? This changes the rules of the regime. And the reason why so many people have been faked out in the market. And if you had told people back in the worst days of March, back in 2020, that we were going to, the S&P 500 was going to double again. If you told them that in addition to doubling, the employment level in America would still be lingering about 5% below where it was at the beginning, and that we'd be having close to 2,000 deaths per day after 18 months. And yet we'd see the S&P double. They would have thrown you out of the room, right? And meanwhile, we've had the 40th anniversary of the bond bull market, right? We saw September 30th, 1980, we had bonds 10-year yield at 15.8 something, I think 15.84. What's going on with that? At a time now when the economy is recovering, the S&P 500 doubled. I mean, how do you see bonds so low? Well, turns out now they're not quite so low. maybe they're shifting in a slightly different direction now. But here's the point. Why do the old rules don't work? Why do all those valuation rules, that we talk about, like Shiller's PE, earnings to sales ratios, or
right? They just haven't mattered for the past half decade. Right? Yeah.
So they've all, they're off the charts. They've all been screaming sell, but if you had sold recently, you would have been killed, right? So this is a really important question for investors. Why are all these rules not working? And I would submit that we're changing regimes now. We're going from an old regime, which we call, sort of the neoliberal regime. The Fed just, buys and sells at the short end to influence interest rates over the business cycle. And the federal government keeps the budget reasonably balanced because they can't expect the Fed to bail it out, right? And a little bit maybe in a crisis, the Fed will offer credit at penalty rates, kind of the old Badgett rule. In the new regime, which you could call the MMT regime, right? Well, what is it now? The Fed can buy any asset at any maturity. It can flatten the entire yield curve down. It can also go after high risk credit. It can do anything it wants. And the federal government can basically cut taxes or expand benefits any way it wants to, and the Fed will just monetize the difference, right? You can't banish the concept of valuation. But I would argue that it's now, because of the regime change, operating on a big delay, and it's operating indirectly, right? We have a new regime. It still has to operate. There will always be something called valuation, right? But it's going to operate differently now. And I think what's happening is that in response to this, we're seeing, I think what's clearly with this, huge monetary stimulus. I mean, the combination of the fact that this enormous borrowing, which is going to continue, right, through the 2020s, and the Fed flattening of the yield curve, which is further inflating the demand for equities because it's just encouraging everyone to borrow. I mean, you see mergers and acquisitions going to record levels, buybacks now. We may be a record buyback in the third quarter. Amazing. Everyone is, because here's the new policy is it doesn't matter what you buy after having borrowed. That's a slam dunk. You can borrow anything now and invest the money in anything and you'll be a winner. I mean, we have now long-term treasury yields, which are not only several percentage points below the CPI or the PCE, but 90 basis points below even what bondholders themselves expect long-term inflation to be.
Isn't that crazy? Yeah, we've got junk bond yields below the CPI.
Exactly. High risk end. So what that means is that the only way this can be rectified ultimately going down the road, and it will, it all depends on the speed at which this happens, depends a little bit on Congress, but it will be inflation and inflation expectations. So I really do believe that this is how it's going to play out. Ultimately, of course, inflation, you remember, particularly when inflation expectations begins to accelerate, puts an end to everything, right? The Fed has to change course. And even the MMT theorists agree. Yeah, once you get, accelerating inflation, you have to stop the whole credit creation factory, right? So the Fed is going to have to start, reversing quantitative easing to quantitative tightening. It's going to have to then start raising the front end. And then, of course, the back end will rise as bond yields rise. But then what's going to happen is that's going to, not only will you have a higher discount rate, which will pull down the valuations of equities, but also it will tend to deflate and make collapse all the debt pyramids, which underlie a lot of the investing in equities, right? So all those buybacks, all those borrow to invest schemes that everyone has, all that's going to be, going, right? Particularly at the high risk, starting at the high risk end, right? And then finally, and this is the killer, this is what I think people don't realize, fiscal policy will be unable to neutralize. And I think that's what people don't understand. Now, you remember back the last time this happened with Volcker, right? Volcker suddenly said, we got to get rid of inflation. We're going to just stop the growth in the money supply. I'm going to let that's when it reached its record, right? 15.8%. Right. That's because he wasn't going to accommodate this. And what was the only way to prevent a real disaster to the economy? Reagan ran huge deficits, right? You remember that was the policy. Monetary tightening, fiscal easing. This is what scares me, Adam, is that in this coming era, once you get those expectations of yields going way up, particularly in the out years, Congress won't be able to do that. You know why? Because never before in history have the deficit projections depended so critically on low interest rate assumptions. I go over every year, I go over the CBO's long-term budget projections, right? And they're now projecting that nominal yields will be beneath nominal GDP growth all the way until 2038. Think about that. So this is how they get to borrow all that amount during the 2020s, early 2030s, without the GDP, debt to GDP ratio growing, because they just assume that we're going to have these extraordinarily low interest rates. Now, once that assumption changes, instead of rising from where it is now, we're about 103, 104% of GDP in terms of publicly held federal debt. Instead of rising and making 150% or something that's already unsustainable, we'll be talking about 250, 300, 350 at that point. And by the way, at that point, we're going to have runs on the dollar, right? So in other words, everyone who holds federal debt is going to think, are we ever going to get this back? Right? So you imagine all the sovereign wealth funds and all the central banks abroad, so they'll be running. So at that point, the federal government's going to have to say, no, we either have to raise taxes or cut benefits. This is not going to be any longer a game of handing out pleasures. It could be a game of allocating pain. That's, by the way, going to make the political struggle much more difficult.